The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box. Here are your headlines today. Global equities shake off hard landing fears as Wall Street powers to its best week since late last year, and European stocks see their best week in 3 months. Goldman Sachs trims its US recession odds to just 20% after a run of upbeat data as attention turns to a key Fed summit this week.
U.S. Vice President Kamal Harris makes her economic pitch to voters facing criticism of her plan for a national price-gouging ban, as fresh polling shows her neck and neck with Republican Donald Trump.
Many Americans don't yet feel that progress in their daily lives. Costs are still too high. And on a deeper level, for too many people, no matter how much they work, it feels so hard to just be able to get ahead.
U.S. Secretary of State Antony Blinken arrives in Tel Aviv as Washington renews efforts to broker a ceasefire deal between Israel and Hamas.
We are setting up for another big week on markets. It feels as though the bulls got absolutely punished in that market rout, and it was the turn for the bears last week. If you look at some of the big market signals we got, I mean, the VanEck Semiconductor ETF up almost 10%, very much eclipsing some of the market gains that you saw, say, in the Dow, up about 3%. So solid performance for the major indices, but very much a bounce-back trading pattern for areas of the market where investors saw that opportunity, long-term entry point that they saw as the market pulled back, so they got involved, and that very much saw that bounce. In terms of the economic negativity that we had, whether we were on course for a hard landing, not a soft landing, it feels as though the data points last week really countered some of that negativity. We had it when it came to the retail sales coming through stronger, Walmart at an individual level, at a company perspective. We saw it in terms of the job claims and also on some of the inflation numbers. So I really think we saw some calm return. The question is whether Jackson Hole now is all about the messaging from some of those Fed speakers trying to just communicate about the pace of rate cuts, because the market got ahead of itself in some ways, saying, look, 50 basis points could be the size of the moves. I think we'll see pushback this week to that scenario.
If there was ever a time probably you wanted the Fed to actually make commentary, it's probably now. The rout has happened, it's subsided, it's calmed down, everything is eased somewhat. Recessionary fears from the likes of Goldman Sachs have reduced somewhat as well. Thoughts are that the economic data, as you've pointed towards, is showing some, softening, but still looking very upbeat still from a consumer standpoint especially. And now is when you want the Fed to then come out and say, well, okay, you've had all of that, but actually the base case is still the same here, right? And they can give a very clear message this week. And I think I've actually had questions around whether the Fed's messaging has always been clear, because after every single data point, there seems to be a Fed official who comes out and offers a completely different point of view sometimes. And it sometimes skews markets and skews perceptions of where the Fed is going. So this week, I think definitely a chance for the Fed with that Fed Jackson Hole Symposium to offer a clearer stance on where to from here.
Certainly on the markets and on the macro, but there's another big theme for central bankers this week, I think, that may crop up, and that is around independence of central banks, because don't forget, Donald Trump has questioned whether if he were elected president, he should have a say over the Fed. We saw something very similar out of Thailand today. So it's not just in the United States now where we're hearing politicians trying to crowd in on central banking space. So look for that theme as well. Well, let's just recap on US equity markets. They've rebounded last week, seeing their best trading week since November. The S&P 500 is up more than 6% since it posted steep declines on the 5th of August. Some of this year's biggest tech names have also staged strong rebounds since then. Chipmaker Nvidia in particular is up more than 20%. In Europe, the Stock 600 posted its best week in 3 months amid strong global sentiment after a slew of US data. Goldman Sachs economists have now reduced their expectations of a US recession in the upcoming year after positive retail and jobs data last week. In a note to clients, it said it could cut its recession probability even lower if the August jobs report, quote, looks reasonably good. And don't forget, this is one of the big investment banks that also spooked the markets in that rout earlier this month.
Well, if you were looking for a winning week, you found one. That's what happened last week, and particularly just on Friday, you had just a meager 0.2% gain then across last week's market picture just on Friday, but really good gains as well across the week, actually, and we'll get to unpack that as we certainly have. But the positive sentiment is still in play, isn't it? The S&P 500, yes, still looking for its mark then pre the market rout we saw around 2 weeks ago, but still question marks around, well, it's going up. Is that tech trade still in play? Well, if you consider the fact that the Nasdaq is still relatively up on the year as well, and when I say relatively, I mean, I'm talking about the Nasdaq having gone up 19.4%, circa 20% then so far year to date, kind of still tells you that that tech rally is still in play overall. On the treasuries front here, I mean, question marks will be around just that interest rate cycle. And that's, of course, what's going to be focusing in a lot this week. And really, Jackson Hole Symposium, that's going to be a key market mover, not just for treasuries, but also for currencies, which we'll certainly be looking towards then. A slight dip then this morning for the 10-year note then. 3.88 is where we're finding it this week, still firmly below that 4% mark. 4.05 then is what you're getting as well out of the 2-year note there. And that's a differential then of around 17 basis points across the two, of course, right now. Again, modest drop on Friday, the 10-year note slipping that 3 basis points, in fact, then. And very interesting to have also looked at the Europe treasuries as well. Bond market will be interesting to look at a little bit later. On to the Asian market here very quickly. And Asian markets mostly up for the week then, seeing a broad rally in stocks as well just last week. Today, though, you're seeing the Nikkei go down 1.4%, a drag on the rest of the Asian market, with the topics actually following it as well. 1% as well for the Hang Seng, 0.5% for the Shanghai Composite. A lot of data still anticipated this week. Kicks off with tomorrow's Chinese loan repayment, loan prime rate, should I say, the 1 year as well as the 5 year said to be released. So keen eyes will certainly be focused on that, Karen.
Well, let's talk about the Fed, as policymakers have been cautious on spelling out whether the central bank is ready to cut interest rates in September. In an interview with CBS, Chicago Fed President Austin Goolsbee said he could not say with certainty that the Fed will lower rates at its upcoming meeting. Meanwhile, San Francisco Fed President Mary Daly said she favoured a more gradual approach to lowering rates, telling the Financial Times that recent economic data provided more confidence. Central bankers will gather for the Fed's annual economic symposium in Jackson Hole in Wyoming this week. Fed Chair Jerome Powell will deliver his key speech on Friday. Traders fully expect Powell will confirm a first rate cut at the Fed meeting next month. The only question is by how much. The implied odds of a 50 basis point cut now sits at 28.5%, according to the CME FedWatch tool, which tracks futures contract trading. Joining us now is Vince Lariso, who is the CEO of Cloud Capital Partners. Vince, thank you very much for joining us today. It seems as though last week, as the bulls mounted a defence, that it was a very fast-moving space, that if you missed the dip, then you perhaps missed a long-term buying opportunity. What do you make of that? Because we were always told, don't buy the first dip, there'll be more opportunities coming.
Yeah, well, it was certainly an interesting week and what's been an interesting year, right? But we step back at Cloud Capital Partners. We look at the equity markets and we think this is a really good time to be invested in equities. We think active managers are probably well suited to navigate this environment. But the reasons are not necessarily the things that everybody's fixated on. From our perspective, these questions about when the Fed will move and by how much is really difficult to answer. A lot of questions about the U.S. election cycle and what that means for the markets. Again, that's an area we're not really going to delve too deeply into. We just step back and say, look, the fundamental drivers of equity performance are in place. We've got a slow growth economy, but we've got money supply capped. Credit's not expanding. Companies have a lot of cash on the balance sheet. They're generating a lot of cash. So whether we talk about buying the dip or timing the market, that's really difficult to do. We've been managing assets for our clients now. We're in our 25th year. So, we try not to be too precise week to week, but we do step back right now. We're very constructive on equities. We're really excited about some of the investment opportunities that we're finding.
I see in your research you say tech and AI are the place to be. And as we take a look at some of the big stocks in the Friday trade, there was a little bit of churn, a little bit of choppy waters in what seems to be the market leaders over time. In recent times, the market has been driven by the likes of Goldman Sachs and Microsoft. But if you just looked at the Dow performance, it was Goldman's to the upside, Microsoft to the downside in the Friday session. Even on the S&P 500, it was Nvidia to the upside and it was Meta to the downside. So it doesn't feel as though the market is completely convinced to buy all stocks at this stage.
Well, I think that's a great point, right? And so often we talk about equities as whether you want to be risk on or risk off or own the S&P or not own the S&P. I think it is time to be a little bit more precise about which sectors and which companies, looking for those drivers. So you mentioned we really do like technology and AI. It's because of their potential to grow revenues, obviously, but they're already generating significant free cash flow. We think the valuations are attractive enough on a long enough time horizon because that's the big kind of investment cycle right now that we see in the capital markets is AI and the build out of semiconductors. But of course, the market is going to reposition. I mean, we're in front of potentially a Fed rate cut regime after a kind of a long pause, and that's enough reason for some investors to reposition across certain equities and specific stocks. Of course, we've had a little bit of the unwind of the yen carry trade, so the repositioning and the spikes in volatility, that's not entirely uncommon. Again, we think if you step back and look for investment cycles, the tech AI theme is very strong and investable, we think, for our clients. But even other sectors are offering some interesting opportunities. We own biotech stocks and we own some energy names. We think gold miners are interesting right here. So it's, as I mentioned, we've been investing across cycles now for more than 2 decades. And this does feel like one of those fairly unique periods in time where if you can combine a strategic perspective, have a perspective on the capital markets, understand what's going on with money supply and growth, and then do the individual security research, that's what's unlocking for us, we think, really interesting opportunities for our clients.
Yeah, I mean, Vince, you're literally speaking about how the last 2 weeks in many ways has also proven how significant active management has been as opposed to passive management. But you're not worried about what looks like bubble-like characteristics of some of these mega cap players. You still think there's a lot of room to go. Why is there no worry that perhaps you reach a ceiling at some point here?
Yeah, it's a fair question. I'd say there's plenty of concern, plenty of worry. We are very conscious of our downside risk. But one of the interesting dynamics about this move in technology relative to maybe the tech bubble from the late 1990s is if you think about the balance sheets of these companies and their free cash flow generation. There's some interesting research about the percentage of the S&P 500 that's now comprised of technology. And we always think about that in terms of market capitalization. Of course, it's at one of the highest points we've ever seen it, right? North of maybe 40% now of the S&P 500 market cap is technology. But what's really interesting from our perspective is if you look at the percentage of free cash flow generation across the S&P 500, it's a similar number. So we don't see a dynamic where these companies are way out ahead of themselves in terms of valuations. Of course, the market caps are nearly staggering, but in the context of this investment cycle, what it might mean across economies, across sectors, and given the moats that these businesses have, I mean, their market shares are, almost irreplaceable. You just can't invest in semiconductor capacity and cloud capability and services at the scale of these companies in less than probably a decade. And it would take billions upon billions of dollars to do so. So they are incumbents with huge balance sheets generating significant free cash flow, but they're also in front of an enormous investment cycle. And it is fairly unique. I mean, it's almost hard to get comfortable with these market caps, but the valuation work that we're doing is compelling, and we think that these are still investable securities.
But Vince, then what about the earnings cycle that we've just seen with some of these tech players? How much now hinges on NVIDIA and the demand that they show over the next couple of months or years as well? And what does the rate cutting cycle then have to do with this at all, if anything, in terms of seeing these stocks move a little bit higher from here?
Yeah, so the earnings are going to be monitored really closely. Of course, NVIDIA is later in the month. It's probably as important as anything we're going to hear from the Fed this week, right? If you think about the influence of this company across the capital markets right now, it's very profound. But I think they'll continue to deliver the backlog, the revenue growth, the earnings visibility, and the market is always going to be comparing the actual results with expectations. So there's going to be room again for volatility, and we try to be tactical about when we're going to change our position sizes and when we can move into more compelling investment opportunities. I would just step back and say, look, the broad investment cycle here around technology and AI is what's so compelling. Day to day, week to week, earnings to earnings, that's what active managers are tasked with analyzing and trying to understand valuation opportunities that present themselves. But the broad picture, I think what we're going to hear from NVIDIA is, look, this is an investment cycle that is profound. So sometimes you get some stock moves around the timing of new generations of chips, and you have to look at the lead time on some of the investment cycles that they're experiencing. But I think on a long enough time horizon, you can own these companies.
Vince, let's talk about Jackson Hole. We've got Jay Powell talking later in the week at the key symposium. Already, Mary Daly's been talking about the economy not being in an urgent place, and gradualism is not weak when it comes to these interest rate cuts. Do you think this could be market moving this week?
Well, I'm sure it will be, right? But the question will be, is that near-term volatility around expectations, or is that a real change in the investment cycle? And even though the Fed has been slow to reduce rates relative to expectations we would have had maybe a year ago, right? The market was pricing in as many as 4 or 5 cuts this year. Clearly, we're not going to get there, but equities have performed really well. In your opening, roll down of the markets today, we saw significant year-to-date performance in the S&P and the NASDAQ. So indices and equities can perform well, even as we all wait with bated breath for that inevitable, what looks like now an inevitable move in the Fed funds policy rate. So this week, if we get more clarity on September, I think the market's expecting that. If the Fed disappoints, I'm going to get a sense that they're not ready to go. I think that would be a shock to the market and we would have volatility. But nonetheless, we're in this environment where you're just not seeing an expansion of credit, right? You're not seeing money supply grow. You're seeing some wage normalization, right? Because of immigration in the United States and some of the supply chains that are loosening, the overall dynamics that are ultimately going to drive equity valuations, we think are very favorable. And sometimes, we get lost in the different variables that comprise that overall backdrop. And again, so week to week, depending on what we hear this week, maybe a particular earnings call, you can get volatility, but we're really constructive on equities because of those big drivers. They don't change very quickly, right? We want to be able to pick the date and the magnitude of changes in the Fed funds rate. And that's relevant to the markets on a short-term basis. But you step back and think about demographics, growth, inflation, money supply, credit expansion, and things look pretty good for equities right here.
Vince, thank you so much for joining us today. We do appreciate your thoughts. Vince Larissa with us, CEO, Clark Capital Partners. And don't miss our special coverage of the Fed Symposium. Our US colleagues will be live from Jackson Hole later this week. And don't forget, of course, we're still setting up for about a 4 percentage point rate cut that the market is pricing in by the end of the year. So perhaps something changes on the back of what we hear this week from Jackson Hole. Yeah,
all of that data will certainly be interesting. But here's also what's coming up on the show. We'll look ahead to what to expect from another packed week for the markets, headlined, of course, by Fed Chair Jerome Powell at the central bank's Jackson Hole summit, as we've just spoken about. Plus, Secretary Blinken touches down in Tel Aviv as diplomatic efforts continue to find a peace deal. We'll have the latest from the region. That's coming up next. And we'll dig into the market action then, what to expect from the Fed with Plurimi Wealth CIO Patrick Armstrong. That interview is coming up at 8 a.m. CET.
CNBC Connect is back in Bangkok, Thailand. Join the world's top entrepreneurs and C-suite executives for an invite-only leadership retreat. On the agenda, powering innovation and growth in Asia. Is AI transforming industries and creating opportunities? And get insights on building sustainable and resilient businesses. Be part of Managing Asia Live. Network and join an interactive brainstorm session. CNBC Connect, powering innovation and growth in Asia on September 4. Register now.
A big week ahead in US politics. Democratic presidential nominee Kamal Harris has delivered her economic pitch to voters, promising a new tax credit for families with children, $25,000 to help first-home buyers with down payments, and a national ban on price gouging on groceries.
When I am elected president, I will make it a top priority to bring down costs and increase economic security for all Americans. As president, I will take on the high costs that matter most to most Americans, like the cost of food. We all know that prices went up during the pandemic when the supply chains shut down and failed. But our supply chains have now improved, and prices are still too high.
The vice president's price gouging proposal has faced criticism, with economist and former Obama administration member Jason Furman telling the New York Times it could stop the economy from balancing itself. Meanwhile, an Ipsos poll for ABC News and The Washington Post shows Republican candidate Donald Trump with a 9-point lead over Harris on the economy and inflation. Trump hit out at Harris's economic plan, saying it would lead to food shortages and higher inflation.
Who would believe this? 80 days from now, we are going to defeat a communist known as Kamala Harris. She's a communist. Most radical left person ever to run for office. This is not what this country needs. We've had enough of them. We're going to win back the White House, and we're going to take back our country.
A YouGov poll for CBS News released Sunday shows Harris with a narrow lead over her Republican opponent, with an even split among voters in 7 key battleground states. The latest New York Times poll of 4 battleground states in the Sun Belt region of the United States also showed an overall dead heat, compared to a 9-point lead for Trump over Biden in the same states in May. Well, Sylvia joins us now with a look ahead at what could be a pivotal week for markets. Sylvia.
That's right, and very good morning, guys. Well, from politics to earnings as well as the macro picture, here's what we should be paying attention to this week. Starting with the politics, all eyes will be on the DNC with Joe Biden speaking today. Then, of course, the VP is speaking later this week on Wednesday. And perhaps the big highlight is likely to take place on Thursday when we hear from the Democratic nominee Kamal Harris. When it comes to earnings, we'll get a good picture of the retail sector stateside. We have Macy's and Target reporting on Wednesday, and Peloton also due to release earnings on Thursday. However, the most impactful headlines for the markets could come from central bankers. The latest Fed minutes will be published on Wednesday, and that is just before Jackson Hole begins on Thursday. Now, the chair, Jerome Powell, will be speaking there on Friday, as will the Bank of England Governor Andrew Bailey. Now, with expectations on what the Fed will do in September changing so much over the last couple of weeks, perhaps the central bank gathering will bring a little bit more clarity on how big the Fed's rate cutting cycle could be.
Well, Sylvia, come back and have a broader chat to us. But I was just looking at some of the expectations there. Don't forget, last week, Walmart did move the market. Yeah. The fact that we saw fairly decent numbers, 4.2% increase in same-store sales at Walmart, stock at a record high. I think the market will be looking towards Target and Macy's too. And let's face it, they are not Walmart. Walmart has been a very strong executor in the retail space. So whether we see the same sort of euphoric response in Target and Macy's at this point in the cycle will be key. But I think the reality is, and we're just saying before the break, the market is still expecting a fairly large swing in interest rates from the Fed this year, a 4 percentage point cut by the end of the year, which bakes in 150 basis point move. And the messaging we're going to get from Jackson Hole, if Mary Daly is any indication, they're going to be talking about a slow pace in rate cuts.
It seems that we are at the same level that we were at the start of this year, where we have the markets a lot more bullish in terms of what the Fed is going to do this year. And we know the market expectations have changed a lot throughout the last couple of months. I mean, even if you just look at last couple of weeks, with some people potentially suggesting that we could see an emergency rate cut from the Fed at one point, right? So these expectations have changed significantly, but it does still seem that we have a bit of a divide between what the central bankers are communicating and what traders are actually pricing in. And actually keep a close eye on what the expectations are. And at this stage, there's a 71% probability that we're going to get a 25 basis point cut in September. This number has changed slightly over the last couple of weeks, but in the last couple of days, it has gotten stronger when it comes to that 25 basis point cut. And indeed, the message that we got from Mary Daly over the weekend, speaking to the FT, was very much in line with this current expectation that we're probably in a position where the Fed is more likely to cut by 25 rather than by 50. But then the point is, what happens for the rest of the year? Can they actually deliver on the market expectations for a full percentage point cut? It seems quite aggressive given that between September and December, they don't have that many meetings to actually decide new rate cuts. So it'll be interesting to see what will be the message from Jackson Hole this week. And of course, what the Fed minutes will also indicate when we get them on Wednesday. But no doubt, I would highlight this as potentially being the headline for markets this week, the message on monetary policy.
So imagine if they were to cut by 25 basis points now in September, right? And then they decide to try and keep up with that narrative of 100 basis points cut this year. You then cut by 50 basis points the day after an election in the US. And then you cut again by another 50 basis points or 25 basis points then in December. I mean, I'm not saying that they're trying to be political, and I'm assured that they probably won't be. But there's going to be political question marks put forward.
See, I think it's dicier if you cut before the election. So if you get the rate cut in September, which of course is one of the scenarios we're talking the other week, that there could be a 50 basis point rate cut in September, that for me would have been highly political.
Yeah, probably would have been, yeah. You're 100% right. But I'm just wondering whether even, and so if that is the need then to feel like you have to cut 50 basis points, would you not rather front end it and then ease the rest of the way? Or does it create panic?
But the message from the Fed has been very calm, really, and they're not really paying attention to what traders are saying either, right? No. They're saying they're having their own path. They're not paying attention to the politics. It's a tricky position to be in ultimately, but they always say we're politically independent, don't they? These
are the same traders who said there'd be 6 rate cuts this year.
Yeah.
So, of course, things can be taken with a pinch of salt here.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabi Lekumete, weekdays on CNBC.